Morning, everyone. We are at the end of a pretty busy week in financial markets. An interesting week, all the same, on a week that we had the Federal Reserve. Now, we can see on Wednesday we had the interest rate decision out of the Fed, and that was really the main talking point of this week. Now, they did hike rates by 75 basis points, but they were a bit cloudy in their judgment of, or cloudy in their remarks on future guidance about future rate hikes, and probably showed a slight reluctance to continue hiking rates at the aggressive pace that they have been throughout the course of this year. Now, that's 4 interest rate hikes on the spin, back to 2.5%. We are at levels in interest rates last seen back in 2019. Now, interest rates higher than what we currently have. We have not seen since 2008, before the global financial crisis. So we're back to quite a substantial interest rate on the Fed, back to 2.5%, and they see it maybe reaching a band of kind of 3%, maybe 3.5% by the end of the year, which, with it being July, still being July, shows a reluctance to continue to hike rates at the pace that they previously have done. Now, what that has resulted in is some good trading opportunities over the course of this week. Now, we can see across the board here on the US dollar, we have seen a weakness across the board on the US dollar. You see Aussie, if you look at these, you just look at each individual charts. The Euro's kind of the odd one out. We've got the Aussie clearly higher, Kiwi clearly higher. Euro's kind of a little bit sideways, a little bit down this week really on the Euro, but then you look back to cable, dollar Swiss, dollar yen, dollar CAD, and the dollar index all moving lower. Now, the dollar index still moving lower, being pushed by the other currencies. Obviously, Euro not having a great time of it at the moment. Has not managed to gain as much of a foothold, but we have over the last kind of 24 hours had a bit of upside in the Euro, so that would be interesting to see how that closes into the weekend into the weekend this evening. Now, we come across the stock index as well, and stock indexes have been enjoying the same thing. Dovish Fed, weak dollar. Well, not dovish Fed, they hiked rates by 75 basis points, but for me that is potentially peak hawkishness on the Fed, and stocks have liked that over the course of this week again. You see the S&P 500, you see the Dow, see the Nasdaq over here, and the Russell, the 4 US indices cruising higher. The DAX is the odd one out again. The European stock index, the DAX wasn't enjoying itself, but has picked up again recently in over the past day. Again, continued grinding upside in the FTSE. Euro stocks marching higher again, pretty impressively outpacing that of the DAX, and the VIX cruising back down towards that 20 level. We'll come across again to the US 10-year yield and have a look at the US 10-year yield, and we can see quite a clear head and shoulders pattern. Right, we see a clear left shoulder, clear head, clear right shoulder, and we have broken out of the neckline over the course of this week. Now, I'm not the biggest fan of technical analysis on things like bonds, but we can see here it's clear as day. It's a clear transition between higher lows and higher highs to lower highs and lower lows, so a clear bearish shift on bonds. And then when you take all that into consideration, you're looking at US dollar downside across the board, you're looking at stock index upside across the board, and you're looking at bonds lower through this neckline. That is some good trading decisions, trading opportunities. When you can get clear direction off the Fed, clear hawkishness, clear dovishness, it gives clear direction for certain assets, and just shows when you go back to the calendar and you have a look yesterday at the US GDP figure. It just shows when you look at equities the kind of mental gymnastics of people to just try and get long indices again. Some people, if they didn't make enough money in that big bull run up, the 18 months post the beginning of the pandemic. Stocks have been difficult over the course of this year. We're now in July and we've been trending lower for the majority of the year. It would be nice to establish some upside, establish some higher lows and higher highs, something we were looking at earlier on in the week. So or last week, on the market insights last week. So, clear foothold being gained across these stock indexes. We've clearly posted a bit of a floor. Whether that proves to be a permanent floor remains to be seen. But, I was saying last week, I thought the low was potentially in. We did have this bit of a flag here, as you can see across there, and then popped higher again. So that, the signs were there that we were shifting, we were turning around a bit on these stock indexes, and then the Fed just came in and gave it a bit of a kick, and stocks have then moved higher. I don't think I can really be fully comfortable about kind of longer term longs really until probably we're through something like that and start to really kind of establish higher lows and higher highs. once we're looking at this, we're still technically in the downtrend. I mean, nothing massively has changed just yet. You know, the Fed are still in a hiking cycle. Yeah, okay, they're coming to the end of it. They're still in a hiking cycle, so we need to be careful. But you know, with the sentiment that is in markets now, it's clear risk on sentiment across the board. Dollar lower, stocks higher. You know, it's a good time to be on you know, good time to be a buyer of stocks. I think in the short term, medium term and long term might be a bit more difficult, but I think the bullish momentum is definitely there at the moment, and we can continue to buy, you know, until we can't. But you know, that is really the main story of the week. That is the main story of the week. This as well is interesting though. GDP in America, consensus was for 0.5%, so a growth. Once we take into consideration that the last quarter of GDP in America was negative again, was a contraction again, we come through to this figure. Now, this is only the advanced figure. It is the advanced figure, so it's not, you know, the kind of nail in the coffin as such, but, you know, the technical term of a recession is 2 consecutive quarters of contraction of GDP, and that is what we will get if the final figure matches up with the advanced figure. So, you know, it's interesting. You know, US economy technically in a recession, and stocks fly higher. It just shows the willingness to buy stocks, the want to buy stocks. And if you know, investors get a reason to buy stocks, that is the side of the market that we want to be on, and they are assets that we want to be focusing on. We'll come around to next week. We will have a look at next week. We'll flick this up, and we've got a couple of interest rate decisions. We've got a couple of central bank announcements out next week. We've got the RBA on Tuesday. Now, they did hike rates by 50 basis points at the last meeting, 50 basis points at the meeting before, and 35 basis points at the meeting before that. So we're looking at 4 hikes on the spin. Across the for the RBA. Consensus forecast, whatever way you try to look at it, is back to 1.85, so a 50 basis point hike. It'll be interesting to see the commentary around that 50 basis point hike, is if that is exactly how it plays out. Reason being that at the last meeting, when we got the 50 basis points, you know, in the statement, they did suggest that there was more chat about a 25 basis point hike than there was about a 75. So it will be interesting to see what sort of commentary we get along with that RBA hike. Are they going to be like the RB&Z and kind of give dovish commentary with their hikes and try to keep the currency somewhat subdued? We'll have to see how that plays out across next Tuesday morning. But apart from that, then we've got the Bank of England, 12 o'clock next Thursday. Consensus here 1.5%, forecast 1.75. So market participants and analysts are a little bit undecided as to what we will get on the Bank of England, so that will be interesting again into next week. Potentially may provide some trading opportunities off the back of that. We'll then roll into Friday. You know, we'll have a statement on the monetary policy then from the RBA, but then we come into non-farm payrolls on Friday. Right, consensus is for job growth of 255k. That would be less than the previous month. So, you know, the job market is pretty tight, pretty good in America anyway. So, well, 100,000 here or there, I don't think it's going to really change the picture too much. So have to see again how that plays out, but might end up being a little bit of a non-event if it is around consensus and around those previous figures. So I think Bank of England and RBA may provide better trading opportunities next week, but I wouldn't rule out a trade on NFP at all. Apart from that, we can continue to look at markets, our cross-asset correlations, our charts, our fundamentals, and try and piece together what is going on in terms of geopolitics. But in terms of the calendar, Bank of England, RBA, and NFP as of next week. But we will be sure to cover them when the time comes. I'm going to wrap it up there then, folks. Have a good weekend. That is it from us for this week. Have a good weekend. Do get some rest and relaxation into you. Enjoy some time with some friends and family if you can. I think we might get a bit of decent weather today and tomorrow, so do enjoy it if you can, and we will be back again next week with another few videos, and same time again next Friday for another weekly market insights. Thank you.